Hi guys, good afternoon and welcome to Mutual Fund Corner. I'm Pavitra Parekh and today we have a very special episode because we are going to answer all of your mutual fund related queries. So many of you write into us on our Twitter, on Instagram and ask us for responses about mutual funds. So we have with us today Shweta Rajani, who's Senior Vice President and Head of Mutual Funds at Anand Rathi Wealth, to answer all of your specific mutual fund queries. Shweta, thanks a lot for being on the show today and taking out the time for our viewers and, to take them through what their queries really are. The first one comes in from Caroline Pereira, who writes to us from Karnataka. She has been investing 5,000 rupees in the Axis Blue Chip Mutual Fund and 3,000 rupees in the Mirae Asset Large Cap Fund. She says she wants to invest another 2,000 rupees monthly and she wants to know an appropriate fund and asks if her current holdings also need any changes. So quite a few questions thrown in there. Shweta, first your call on both of these funds that she holds, which is the Axis Blue Chip and the Mirae Asset Large Cap Fund. I mean, both of these are large cap funds, so take us through what you think of those. And also, she said she wants to invest 2,000 more per month. Where would you, suggest she put that money?
Sure. Thank you, Pavitra, for having me on the show. Hi, Caroline. So 2 points. One, and I must say that, it's a good thing that you've started with an SIP and you're increasing that SIP. It brings in that basic discipline of investing. So, thumbs up to you for that. 2 points on the existing schemes. You have both the large cap schemes. Now, large cap fund category. If you see, there are, 10 different equity categories through which you can invest. Now, large cap as a category is the one which has the least potential to outperform, let's say, a Nifty 50 benchmark. This outperformance is what we generally call as alpha. So you're in a category which has the least alpha potential. So one thing is that you definitely need to diversify it across other categories. Now, between the two schemes, Axis Blue Chip and Mirae, I would suggest you to hold on to a Mirae large cap scheme. It's been one of the consistent performers. While each fund goes through its cyclicality, this has been one where the fund manager's style has been very flexible to the changing market environment. Axis Blue Chip for the last 2 years has been struggling because they have a growth-oriented style and values been playing out in the market. So this is one fund I would suggest you to exit from. Retain a Mirae large cap. That basically means that the 5,000 plus the additional 2,000 that you want to put in, 7,000 rupees you need to spread out across other categories. You also need to have some more of mid and small cap exposure to your portfolio, because with these schemes you have 90% investing in the top 100 companies, what we call as large cap. So my suggestion to you therefore would be to have a 50-50 mix, 50% large and 50% mid and small, and therefore look at other categories like having an SBI large and mid fund, Kotak emerging, DSP small cap. So what happens is you get a mix of different market caps that will help you across market cycles, and also have an SBI Contra and an HDFC Flexi Cap. So you have both growth-oriented and value-oriented styles for your portfolio. So expanded from 2 schemes to ideally 6-7 schemes across market caps, across different styles.
All right, that's very helpful and I'm sure, it can help a lot of other viewers as well, just in trying to tailor what their mutual fund investment should look like. Shweta, the next query comes in from C. Venkatraman. He writes to us from Kerala. He says he's been investing 1,500 rupees in the Kotak Emerging Equity Fund since the last 2 years. So this is one of the funds that you mentioned as well. He says he would like to invest in any mutual fund by SBI now. Your answer here, would you recommend anything from the SBI group?
Sure. So Kotak Emerging that you're having, again, has been one of the consistent performers in the mid-cap, so it's a good fund that you have in your portfolio. Kotak Emerging, again, invests in high-quality mid-cap companies where the earnings growth potential would be on the higher side. So within SBI, a best fit to counter this would be a SBI Contra fund. So SBI Contra has a value tilt to its portfolio. So you'll have a growth style, you'll have a value style. Depending on how the market environment goes, it will balance out each other. The second benefit of having an SBI Contra is Kotak Emerging is mid-cap oriented. SBI Contra has a little bit of large cap orientation on its portfolio. So again, you will get a market cap split as well. However, if you have more funds, then I would suggest instead of 2, here again have at least 7-8 schemes in your portfolio.
All right, so maybe you should expand a little bit here as well. The next query comes in from Reena Ori, who writes to us from Chandigarh. She says she's been investing in the markets as well, and she has 3,000 rupees in 3 funds, in the Quant Midcap Fund, Aditya Birla Sun Life Digital India Fund, as well as the ICICI Pru Tech Fund. Every month she's been putting in 3,000 rupees. She wants to know if a portfolio needs any change. Shweta, would you review this portfolio for us? What do you think of her choice that she has Quant Midcap, Aditya Birla Sun Life Digital India, and ICICI Pru Tech Fund?
Sure. So, Reena, out of the 9,000 rupees that's going in per month, 6,000 is going in a particular sector, which is technology. So, I would say roughly 66% of your portfolio is IT oriented. Generally, fund managers, if currently, would be having anywhere between 12 to 15% of their portfolio in tech. If you take a particular sector call, it means that you've decided this particular sector is going to do well. Timing becomes very important for you to enter as well as exit. If you miss out either of those at the right time, your returns could drastically go southways as well. So my suggestion to you would be, do not take a sector call, do not do 50% job of the fund manager if you're not spending your 24/7 tracking markets. Quant, on the other hand, is a good scheme. They have, good data-backed analytics that they do. So Quant Midcap is something that you can hold on to in your portfolio. If you hold on to Quant Midcap, then you need to have, large and midcap oriented schemes in your portfolio. Therefore, you need to look at something like SBI Large and Mid, an HDFC Flexi, those kind of schemes in your portfolio. Again, SBI Contra, which I suggested to the other viewers as well. Those are the kind of schemes that you should have. Any which ways you will get 15% odd exposure to tech. And when the cycle plays out, the fund manager would be far more active to turn to other sectors.
All right, that's very helpful. And this is something we've spoken about on the show as well before, that sometimes if you're trying to get into a sector fund, you don't know which one to get into, you just end up sort of buying into 2 or 3, and it just increases your portfolio exposure for, and that's of course, never a good thing to have such a concentrated portfolio. But the next query comes in from Shashank Bharadwaj, who writes to us from Ahmedabad. He asks that in the wake of the SVB collapse and the following route, how should he look at debt funds? He asks which category among debt funds he can really pick. Shweta, we talk about having exposure to debt very often on this show, and it is, of course, a good idea to sort of balance your equity with debt. But there is also an interest rate risk element, right? Do you want to take our viewers through that?
Sure. So, I'll first address the SVB point and then move on to what debt and what are the risks there. So I'm going to take 2-3 minutes on this. To a specific query on SVB, now, the Silicon Valley Bank, the impact there, to my mind, whatever our reading of it is, it should not have a drastic contagion effect on the other banks. Okay, so we need not worry so much on that. Also, here I want to highlight that the situation in India is different than what you would see in US, right? So, for example, we're used to a 6.5% kind of an inflation over a longer time period. So 10-year average inflation CPI has been at 6.5, which is where you are currently. If you see the 10-year government bond yield for us has been at around 7% and you're at 7.3%. It's not like, a US where you're used to a 1% inflation and then you suddenly see your inflation jumping to 7% odd levels and, then easing off. Likewise, US, GSEC, it's not that you're used to a 1.5 there and then you go up to a 4.5, 5. So India specific, if I have to, look at, we are in a much better situation. The debt allocation, like Pavitra was mentioning, you need to have some debt in your portfolio to bring in stability of returns. Right, so you need to have a good combination of equity and debt in such a way that you're making inflation-adjusted returns as well as managing your risks in volatile period. Specifically coming to debt. Now, when you invest in debt, you have an interest rate risk. If I have to explain what an interest rate risk is, let's assume you've taken a bond at 100 rupees at a 7% interest rate. Now, next day, the same issuer increases the interest rate from 7 to 8%. The value of your bond would fall from 100 to, let's say, a 95 because the same issuer for the same tenor now is offering a higher yield. So the value of your bond comes down. This is my interest rate risk. How do I mitigate this interest rate risk? Today you have options of what we call as target maturity funds. Okay, these are funds which follow a roll down strategy. The fund manager would buy a paper and hold it till the maturity. Let's say something like a GSEC June 26 target maturity fund. It's buying a GSEC paper. It's going to hold it on till June 26. What it means is if you're entering today and let's say your entry yield is 7, if you hold it till June 26, you don't have to worry about the interest rate movement in the interim. On maturity, you would get your 7% back. So you've mitigated the interest rate risk. Second risk in debt is generally your credit risk. Now, if you're investing in a 100% central government target maturity fund, then you're eliminating your credit risk as well. There's third element to this, which is you have a visibility of return because you know what you're entering at is what you generally get towards the end of the tenor. So it brings in that stability which is needed from the debt portion of your portfolio. And you would not need 8-10 funds because I'm not eliminating credit risk and we're also eliminating interest rate risk to a large extent. So pick up 2-3 of these target maturity funds. In fact, these are funds which if you are, let's say in the 20 or a 30% tax bracket, works much better than even a bank FD because you're getting a quality which is better than any bank. It's the central government. You're getting more tax efficiency because you'll end up paying 20% plus indexation. So you easily get, back of the mind 2% higher than what you would get post-tax basis to an FD. So go ahead with your debt. You don't have to worry about what's happening with SVB, but be clear of how much portion of your money you want it in debt and how much in equity.
All right, and that of course will vary for every individual based on what their targets are and what their risk profile is as well. Shweta, that was very well explained, and I think it really sort of broke down this question for everybody who's tuned in to us right now. But with that, we do need to get into a short break. I request you to please stay on because there are lots more questions, and we will continue this chat when we come back.
Oh, yeah. Settle down. Oh, yeah, that's it. I've been through the storm, I've been through the rain. I'm still here standing, unshackled and chained. You better buckle up, cause I set my sights. But this bad boy ain't leaving without a fight. Roll it hard and dark, cause there ain't no fire without a spark.
चीज़ डोसा, मसाला डोसा, पेपर सादा डोसा, रोटी, बटर नान, कुलचा, वेज कढ़ी, वेज कढ़ाई, वेज कोला, स्टीम राइस, जीरा राइस, फ्राइड राइस।
भैया और कोई ऑप्शन?
लाइफ में और कहीं ऑप्शंस मिले ना मिले, मोतीलाल ओसवाल आपको देता है ऑप्शंस ट्रेडिंग में ऑप्शंस। इंट्रोड्यूसिंग मोतीलाल ओसवाल ऑप्शन स्टोर विद अ वाइड रेंज ऑफ ऑप्शंस इन ऑप्शंस ट्रेडिंग। एक्सप्लोर करो ऑप्शन स्टोर। Investment in securities market is subject to market risks. Read all the related documents carefully before investing.
Dainik Bhaskar Group is now in the top 10 media groups in India. Growth because of our beliefs. Growth because news is sacred.
My journey of insurance and investments began at the same time when I invested in LIC SEEP. In this fast-moving world, SEEP can balance your funds with security and growth. SEEP will take care of the ups and downs of the market and will give you fruitful results so that you enjoy the ride. And when SEEP is with you, you can soar high.
LIC's unit-linked insurance plan SEEP offers savings and protection so that you can soar high in your life. LIC, हर पल आपके साथ.
Play it your way. Sarah, this is your space.
Play it your way.
Indiabulls Housing Finance Limited announces a public issue of secured redeemable NCDs, offering coupon rate of up to 10.15% per annum and additional incentive of 0.25% per annum. Tranche 5 issue is open for subscription. To subscribe, log on to indiabullshomeloans.com. For risk factors and more details, refer to Tranche 5 prospectus available on websites of SEBI, Stock Exchange, Company and Lead Managers.
बालकनी
सेम है,
ड्राइंग रूम
भी सेम है,
किचन एरिया
सेम है।
हमने लिए 90 लाख में, आपने लिए 80 लाख में।
ये सेम क्यों नहीं?
क्योंकि आपके और हमारे होम सर्च ऐप सेम नहीं है। जानिए प्राइस ट्रेंड्स और सही ट्रांजैक्शन प्राइसेस on 99acres.com। घर लेना हो या बेचना, 99 acres से ही पूछना।
Turn your dream home into reality with SBI Home Loans. Attractive interest rate, zero processing fee. To apply, call 1800112018 or visit homeloans.sbi.
Hey guys, welcome back. You're still tuned into MF Corner here on CNBC TV 18, and we still have Shweta with us to answer all of your specific mutual fund related queries. The next one coming in is from Nagendra, who writes to us from Bangalore. He says he and his wife together have a monthly SIP of 61,000 running across mutual fund schemes. They want to build a portfolio of 8 to 10,000 crores in a period of 15 to 20 years. He also says that he's willing to increase his SIP amount if that's what it takes. Shweta, I mean, you do have the details of his portfolio. We'll put them on the screen here as well, just for the viewers to see. But, you know, if you could review this, and also considering that he's willing to increase his SIP amount as well, this seems like quite a doable target, right?
Absolutely, Pavitra. So, you know, current holdings between you and your wife are 61,000. We've mentioned that you can look at adding another 30,000 to your SIP. So that basically takes it up to 90,000 per month of SIP that you can do. Now, generally, if you look at, you know, the long-term returns of equity from the market is generally around 11%. Fund managers do add 2-3% of alpha to that. So if you have to say 14% of return from equity looks like a reasonable expectation, then at that growth rate over the next, 20 years, or you'd get to a 15 crore goal. So clearly with a 90,000 investment, you'll comfortably reach your desired goal. The bucket of schemes, there were around 14 schemes what I looked at it. So I'm going to actually bucket it into 3 parts. There were hybrid funds, okay, which was a mix of equity and debt. Here again, an asset allocation decision is a very important decision, and it should be taken at an overall portfolio level. So, you know, let's say you're targeting a 15 crores. To get to that 15 crores, let's say you need to have a 13-14% rate of return. To get that, what is the equity and debt allocation you should have at your overall portfolio? Once you've decided that, then separate out and invest in a pure equity fund and a pure debt fund. That will give you more clarity and control over your portfolio than leaving it to a fund manager who's probably doing a 65-35 equity debt when you need a 70-30 equity debt. So separate out equity and debt. What we have observed is on a rolling return basis, individually managing it yields 1-1.5% better return than the combination of any hybrid. So all of the hybrids that you have, I would suggest you to redeem out of those. The second bucket that I observed in the portfolio was you have a thematic or a sector fund. Here again, investing in a particular theme or sector needs you to time your entry and exit. And if you don't do it correctly, you could miss out on the gains made. It also means that you have to be more, tuned with what's happening with that particular sector or that theme. So all of your consumer trends, digital, I would suggest you to exit from these and invest in diversified portfolios where the fund manager, is taking those sector calls for you. Invest in caps. So like I've been suggesting earlier as well, have a 50% large, 50% mid and small cap in your portfolio. Spread it across 8 to 10 fund houses, and you get the benefit of different fund manager styles working for you. So that would be my suggestion. I think in terms of schemes, what you can hold on to, Mirae Asset Emerging Blue Chip is a good fund, and SBI Contra is a good fund. Those are few that you can continue to hold on. Your small cap schemes in terms of your Invesco, in terms of your Nippon small cap, SBI small cap, PGIM mid cap. These are good funds which you can continue to hold. Add on to this in other categories, I would say like, a large and mid flexi category. Those are the ones which you can add on to this portfolio, so that you're filling in all the buckets of different styles and different market caps.
All right, that is a complete portfolio review for Nagendra, as well as, really helping him and telling him that if he increases his sort of SIP by around 30,000 rupees a month, he can very well get to his target, that is of 8 to 10 crores that he's looking to build with his wife. Shweta, we're going to leave it on that note today, but thank you very much for joining us and taking our viewers through all of these queries that they have sent in. We will also wind down on this show now, but remember, closing bell comes up after this short break, and they're going to take you through the final hour of trade, so stay tuned for that.